Why we told this owner not to sell, and with a $500,000 reason. This is a story about husband and wife who build a strong, profitable dog daycare business, and to face a decision, most owners don't think about it earlier enough. Not whether the business could keep running, but whether the selling now would give them the outcome they actually deserve. The story follows what happened next, why they were told not to sell when they first asked, what had to be changed behind the scenes before going to market, and how timing, preparation, and one major surprise nearly reshaped the deal, and how, in the end, waiting turned into a $500,000 gain. If you're a business owner even loosely thinking about exit, this is a part of the journey most people never see. Henry and Jesse first came to us in mid-2022. They were open and generally ready to explore a sales, but from the surface, it looks reasonable. The business was operating well, customers were loyal, and the brand had real strength in its local market. But once we sat down with the number, the picture changed. COVID had distorted the number. FY20 and FY21 were too volatile. FY22 has stabilized, but only in the second half. From a buyer's perspective, there wasn't enough history to support the asking price or with confidence. Selling at that point would almost certainly have meant leaving money on the table. So we told them something most owners don't expect to hear. Don't sell yet. Not because the business wasn't good enough, but because it would be better positioned with time. We explained clearly what buyers would look for and what was missing right now. The conversation wasn't easy. As you could imagine, they came in expecting to move forward, not to be told to wait. There was a disappointment and hesitation, but they took the advice. Of course, we didn't just say no and send them away. We lay out exactly what could be done if they wanted a fair and defensible price later. The advice wasn't complicated. It was about making the business easier for the buyer to understand and trust. First, clean out the number. Personal expenses running through the business needed to be reduced and removed. Yes, add-backs can be explained, but too many signal a family-run operation rather than professionally operated to buyers. Second, keep expenses consistent. Buyers look at pattern over several years. If an expense jumps up and down, they will ask why. If there's a good reason, that's fine. If not, it becomes a red flag. So keep expenses consistent. Third, show steady revenue. No one expects explosive growth before a sale. What buyers want is stability. Predictable income with modest, believable growth is far more valuable than the big swing. Fourth, protect your margin. Gross and net margins should stay within a reasonable range. Big spikes or drop, even positive one, raise question. Buyers don't like surprises. Calm, steady numbers build confidence. Fifth, avoid major changes right before selling. Unless something generally needs fixing, don't overhaul the business at the last minute. Big changes push sale time, creates uncertainty, and make buyers cautious. Six, reduce reliance on yourself. This wasn't about working less for the sake of it. It was about making sure everything Henry and Jesse did could also be done by someone else. Staff needed to handle day-to-day operation. A second-in-command or trusted manager make a business much easier to take over. 7. Write things down and use them. Process shouldn't live only in people's head. Operating manuals and procedures need to exist, be updated, and actually followed. Buyers want to see how the business runs without guesswork. 8. Act on opportunity now. Potential has no value unless it's already been executed. If there's an obvious upside, act on it before selling. Don't sell idea, sell result. This wasn't about polishing the business for show. This was about making it easier to understand, easier to trust, and easier for next owner to step in and keep it running. Over the next 2 years, they implemented most of what we discussed. So by April 2024, they came back. This time, they were ready. The numbers settled, revenue became consistent, margins held. We formally listed the business in May 2024 at $1.2 million. The detailed IM was prepared and the marketing went live within 2 weeks. Interest followed quickly. 13 inquiries in the first few weeks. Inspections were held, conversation progressed, an early offer came in from Gerard at 250,000 only. It was far below expectation. Of course, didn't move forward. Henry and Jesse were a bit shocked. We reassured them that this was normal. Early offer like these are part of the process. One matter is staying focused, trusting the quality of business, and letting the right buyers emerge. So by September, two serious buyers appeared. Mark submitted an offer of $1 million structure with vendor finance component. Pete submitted an offer of $1.125 million, all cash. On the surface, Pete appeared to be the clear frontrunner. The lease was due for renewal. This has always been known. The plan was to negotiate once the committed buyers were on the table. That's when the surprise landed. The existing rent, approximately $882,000, was below market in the landlord's view. A market review was triggered. The initial proposal came back at around 55% increase, given by the surrounding development and the opening of a new metro station. After extended negotiation, this was reduced to around 40%. Still significant, the single change reduced the net profit by roughly $33,000 a year. The business had not changed, but the future profitability had. This is a point where many sales fall apart. Emotion creeps, expectation collide with the reality. We advised Henry and Jesse honestly again, this price needed to move. They agreed. Both buyers were asked to revise the offer. Henry and Jesse stayed pragmatic. Mark revised his offer to $880,000. Pete revised his to $800,000, still all cash. On headline price, neither matched the original number, but this was no longer just about price. Mark came with a structure, clear transition plan, time for training, support for staff, a plan to hire, to reduce the reliance on the owners. Henry and Jesse cared deeply about their team and customer. They wanted the business to continue properly, not just be sold. Mark was selected. A letter of intent was signed, the $5,000 deposit was paid, due diligence commenced. Due diligence was methodical. Financial, staff, supply, equipment, system, and no surprise. Contract exchange in mid-December 2024, settlement followed in mid-January 2025. Training and transition was structured with continued support post-settlement to ensure stability. Looking back, advising them not to sell in 2022 was the right call. It wasn't the easy option for us as broker. We could have lost the deals, but it was the right one for Henry and Jesse. From the first conversation to settlement, the journey took over 2.5 years. The sale itself took about 5 months. The extra time, effort paid off. If Henry had sold earlier, the business could almost certainly have landed for around $500,000 less. For us, this is exactly what we believe business sales should work. We work hard when the time is right, and we are just as prepared to say no with the guidance when the time isn't. Our role isn't to push transaction through, is to help sellers achieve the right outcome for themselves and for whoever takes over next. That doesn't always mean the highest price, it means the fairest one. If you're a business owner thinking about exit or even just starting to consider what that might look like, feel free to reach out. If this story was helpful, like the video, subscribe to our channel, and leave a comment. This all would genuinely encourage us to keep sharing a real journey like this. Thank you for your time. Until the next time. Bye-bye.